Welcome back to Live from Paris. It's time now to take a look at the day's business news. Owen's here, of course, and we're also joined by Robin Simpson, Senior Policy Advisor with Consumers International. We'll be looking at the effects of the Eurozone crisis on household credit in just a moment. Thanks for being with us. Starting, though, of course, with you, Owen, and the markets. Yeah,
a bit choppy, certainly on the Asian markets, Claire. Obviously, there's been a big rally, a three-week rally, certainly on Wall Street and pretty much everywhere else in anticipation of this summit. Managing to get maybe something meaningful together. We'll, of course, get the details of that on Wednesday. But for now, you can see the Nikkei down by around 0.6%. Again, once again, the yen strengthening against the dollar. Exporters don't like that, of course. But the Hang Seng and the Shanghai Composite are managing to keep hold of some gains there, both around 0.5% up. Just while we're talking markets, a little bit of company news for you as well. UBS, the Swiss bank at the centre of that so-called rogue trading scandal earlier, a couple of months ago, announcing Q3 profits up to $1.1 billion, but that's actually a 40% loss compared to the same period last year. Remember, UBS said it's already factored in the trading loss from that trader in London. That was $2.3 billion. So no surprise, perhaps, that profits are down. And remember, this all comes in the wake of its chief executive resigning, the chief executive of UBS resigning and bringing in an interim CEO to try and turn things around a little bit.
Now, French and German banks had a pretty good finish on Monday. Most closed up around 4% amid general optimism that Europe's leaders can achieve a meaningful deal on Europe's debt crisis. But how much they contribute remains hotly contested. Germany now wants banks to write off as much as 60% of their investments, a figure that seems to rise week by week. And that's triggered a stark warning by the banking lobby. William Edwards has more.
They've already agreed to take a trim, but some German politicians are keen that the banks take an even bigger haircut on their Greek investments.
In the long term, we are going to share the costs with those who profited on the financial markets in the past. In the case of Greece, this means private creditor banks will have to ease off on a part of their demands.
The write-down agreed back in July was set at 21%. But EU leaders are now pushing for that figure to be much higher, with talk of as much as 60%. They say that's what's needed to keep Greece going. Despite receiving 2 bailouts, the Greek economy has been hit harder than expected by the harsh cuts imposed on it and by the lack of a general global recovery. Representing the banks in write-down negotiations is the Institute of International Finance. They've warned that private investors, with around 200 billion euros in Greek debt, can't be forced into taking a bigger haircut.
Any approach that is not based on cooperative discussions and involves unilateral actions would be tantamount to default.
Although a default might see the banks lose the same amount of money as a negotiated write-down, the Institute says it would be worse for Greece because it would close off its access to credit markets for years to come. If Greece were to default, the pressure would also increase on nations such as Italy, causing another problem for the Eurozone. Leaders therefore have to persuade banks that drastically cutting what they're owed is in their own interests, and they're hoping to tie up a deal by the end of Wednesday's talks.
Let's catch up with some more of the day's business news now. President Obama has launched a series of measures to improve lending conditions for homeowners and students. Obama announced the measures, which don't need congressional approval, amid forecasts from Moody's that home foreclosures will reach 1.5 million next year. They include easing refinancing rules for homeowners who fall into negative equity, as well as financial support for those in higher education.
And shares in Netflix sank 27% after the company revealed that it lost more customers than anticipated. The online video rental service beat estimates to post a 49% increase in revenue to $822 million for the third quarter. But the company lost 800,000 clients during that period. That's nearly 250,000 more than expected. Netflix's share price has slumped 70% since the price hike in the summer triggered mass customer defections. OK, let's get back to our guest, Robin Simpson, the Senior Policy Advisor from Consumers International. Robin, thanks for coming in.
My pleasure.
Just give us an overview. We've been talking for months now about sovereign debt crises, banks writing down their debts, but ultimately, whatever happens, if Greece defaults, if there's this wider Eurozone contagion, this all impacts on consumers, from people trying to get credit to getting mortgages and so on. How does this all feed into that?
Well, it's still early days, actually. We're only just getting going. But in many ways, the immediate impact is starting to be on jobs. For example, I mean, the Greek health service, for example, is disappearing because people simply haven't been paid for months and months and months. So already, as the consumers are being affected as users of public services, they're having to pay cash to people for things which previously they would have had for free. The service is almost privatising itself as a result of the staff not being paid. So there's going to be that kind of thing happening in the public services. You know, in the UK, the job cuts, job losses in the public sector have been 4 times more than expected. So that's going to be the immediate impact on consumers. And then in the longer term, we're going to have things like loss of access to credit, negative equity. I mean, the United States, it's still 3 years after the crisis got going, we've still got 25% of American borrowers in negative equity. And in some places like Minneapolis, St. Paul, the big twin cities, half of the householders have got loans which exceed the value of their property. So this is grim stuff. Regarding the Greek situation, I think it's interesting to compare Greece now with Argentina in 2001. The Greek deficit is actually much, much greater than the Argentine deficit was in 2001. But unlike Argentina in 2001, it doesn't have the option of devaluation. And that's why we're talking about these massive cuts, because these massive haircuts, as we call it, because they simply don't have the option of getting back into equilibrium through devaluing currency.
And I'm guessing that experience in Argentina, does experience suggest that consumer protection often takes a back seat when you've got this mass panic?
Absolutely. I mean, again, the consumer protection is hardly figured on the radar. I mean, we now have from the G20 a commitment to improve consumer protection. I've been involved in negotiating improved consumer protection. The wording that was issued last week by the OECD on behalf of the G20, the proposals that have been made are much too weak. They're so heavily qualified. I get very little sense of urgency on the part of governments and indeed the financial sector in bringing in the necessary reforms for consumer protection to really guarantee safe futures for consumers. For example, there is a very insufficient commitment to bank deposit guarantees. Now, here in Europe, we do have bank deposit guarantees. You know, here in France, 100,000 euros are protected in the event of a bank collapse. But the G20 is not committing itself to similar guarantees throughout the G20 economies. So we have big countries like China, which does not have a bank guarantee system. They're considering it, but they don't have one at the moment. And in China, we're witnessing rapidly declining property values after a massive increase in loans. There was a tripling of home loans in 6 years leading up to 2010. Now the property values are coming down very fast in China. So this is the world's second largest economy, about which very little has been said, other than the view of China as an exporter. Their own domestic market is showing signs of instability.
And so you're saying not much can be done really on the international level to help, or not enough is being done to help consumers.
Quite a lot can be done, but it's not being done. I mean, the G20 and the OECD are not showing sufficient political commitment. They're not actually taking on the industry. The industry have lobbied and lobbied to weaken much of the text that had already provisionally been agreed on improved consumer protection. For example, we've argued for minimum standards, such as exist in France for financial products, such as exist in Switzerland, which is hardly a revolutionary state-controlling country. But these basic protections that certain financial products should simply be removed from the market because they're intrinsically unstable, as we saw in the United States, that has not been undertaken by the G20.
Robin Simpson, I'm afraid that's all we've got time for. Thank you very much for being with us. Thank you, Owen, for that look at the day's business news. More news coming up on France 24. Don't go away.
As shown by the example of Equatorial Guinea, democracy thrives and grows stronger in Africa. Thanks to the efforts of the African Union states, sustainable economic development, quality education for all, and training of African professionals involved in the growth of the country ensure the consolidation of democracy and respect for human rights in Africa. In all areas, Africa awakes. Under the guidance of Equatorial Guinea, the African Union is now ready to build a future of prosperity and democracy within the respect of all sovereignty.